If I don't become a millionaire by the age of 30, I'll jump off the tallest building in Omaha. Can you imagine 10,000 rupees becoming 10 crores? This guy did that. Today is the 94th birthday of someone whom and whose company we should all be inspired by. This is a tale of astute investment and the power of patience. Welcome back to another video of this channel. This one is gonna be on Warren Buffett. Warren Edward Buffett was born on the 30th of August in 1930 in Omaha, Nebraska, United States. Young Warren was always intrigued by numbers and money, and as a kid, he used to say that if he doesn't become a millionaire by the age of 30, he would jump off the tallest building in Omaha. After school, he didn't really want to go to college, but he was forced to by his father. So he graduated from the University of Nebraska, but he spent most of his time in the library reading books on investing, and one of them was Benjamin Graham and David Dudd's Intelligent Investor. He says that this book completely changed his approach on the markets and on investing, and when he realized that these two individuals were professors at Columbia University, that was his next stop for his masters. All this while, Buffett had been investing into stocks, and he even bought his own farmland at the age of 19. And after graduating from Columbia, Warren joined his professor Benjamin Graham at his investment firm Graham Newman. He was very good at his job, and by the time he was 27, after buying a house and with $150,000 in the bank, he decided to retire. But very soon he got bored, and I reckon that the dream of becoming a millionaire by the age of 30 would have come back to him, and then he started his own partnership where he was managing money for his friends and family. By the way, if you would have invested $10,000 in Warren Buffett's partnership, and when the partnership was dissolved, if you would have reinvested that money into Berkshire Hathaway, you would have over $100 million today. His strategy was simple: to buy companies that were trading at substantially cheaper than their book value. Now, what is book value? The assets minus liabilities of a company. So basically, if a company were to sell all of its assets and then pay off all their debt, the figure that you would be left with is the book value of the company. And one such company that Warren stumbled upon in 1962 was an old textile firm, Berkshire Hathaway. Berkshire Hathaway was shutting all of its mills because textile as an industry at that point in time was struggling. And then they were buying back their own shares. With the intention of making some quick profit of a trade, Warren began buying shares of Berkshire Hathaway at $7 to $8 with the intention of selling them later at $11.50. Finally, the opportunity arrived. However, when the opportunity arrived, the CEO of Berkshire Hathaway tried to cheat Warren by buying the shares at $11.38 instead of $11.50. Now this pissed Warren Buffett pretty much, and he ended up buying the entire company and firing the CEO of the company. Unfortunately, the textile industry continued to struggle, so he decided to dissolve his partnership and began treating Berkshire Hathaway as a holding company for making investments. This was also the time when he met Charlie Munger, who later on went on to be the vice chairman of Berkshire Hathaway, and he also had a very profound impact on Warren Buffett's investment strategy. He pretty much changed Warren Buffett's strategy from buying any stock at a great price to buying quality stocks at a fair price. When Warren took control of Berkshire Hathaway in 1965, he began phasing out the textile operations and instead started investing in stocks. The big break, however, only came when he started purchasing insurance companies like National Indemnity in 1967 and Geico in 1996. Purchasing these insurance companies was the secret to their growth, and it's precisely the reason why we know Warren Buffett as Warren Buffett today. And here is why. Insurance companies have something called float. Let's see how this works. When we buy an insurance, we pay the insurance company a certain amount of money every month. This is called a premium. Now the insurance companies collect these premiums and invest it into securities like stocks and bonds, and it's for them to keep all the way till the claims are made and there's a payout to us. Now the money that they invest is called float. As long as the annual premiums that the firm is receiving is more than the annual payouts, the value of this float constantly keeps increasing. And using this float, Berkshire Hathaway invested in quality businesses, very high quality businesses, which he believed were trading at a good price, such as Coca-Cola, American Express, Apple, Bank of America, Dairy Queen, railroad companies, etc. It was a slow process, very slow, so to say. Took nearly 60 years. But then eventually the money kept on growing, and today the total net worth, mind you, net worth and not market capitalization, the total net worth of Berkshire Hathaway is almost $1 trillion, the highest of all companies in the US. And all of this just in one generation. In my opinion, there are three secrets to Warren Buffett's incredible success story. Firstly, patience. Warren Buffett is willing to wait for the right opportunities to come his way. Here is something he often quotes from baseball when it comes to investing. The trick in investing is just to sit and watch pitch after pitch go by and wait for the right time to hit a shot, while everyone around you is shouting at you to swing. Reminds me of Rahul Dravid during a test match against Australia when he made just one run in 100 balls. So Warren is willing to wait for the opportunities that he wants to come his way. He didn't suffer from FOMO for that matter, which is fear of missing out, during the tech bubble of the late 90s. He tends to wait for the right opportunities to come before deploying his money. For instance, in 2008, right before the crash, he was sitting at a cash balance of nearly $25 billion. Even today, he's sitting at nearly $180 billion just waiting for the right opportunities to come his way. Second is constant learning. Here is something Charlie Munger, his business partner, often says about Warren Buffett. Berkshire Hathaway wouldn't be where it is today if Warren was not a constant learning machine. According to Buffett, his job largely revolves around him just sitting and reading all day. This is also evident. He was willing to adapt his investing behavior, from buying any company available at a great price to buying only good or great companies at a fair price. This is basically a shift from Benjamin Graham's way of investing to Phil Fisher's way of investing. The third secret is frugality. Now here's something about compounding. 1,000 rupees grown at 25% CAGR become approximately 10 lakh rupees 30 years down the line. Now think about it, the next time you go to a restaurant, spend 1,000 rupees. That's the equivalent of you losing the opportunity to have 10 lakh extra rupees 30 years down the line. Now the urge to splurge can be very real. Buffett, however, has always been very frugal. In fact, even today when his net worth is above $100 billion, he lives in the same house that he bought at the age of 27 in 1958 for around $30,000. He still drives the same 10-year-old Cadillac. You get the point. Now whether this is right or wrong, that's a personal choice, but let me know what you think about this in the comment section below. Anyway, I hope you found this useful. We'll bring you another such case study on next Friday. Till then, subscribe to our channel and stay tuned.